Now, our next guest is in charge of corporate credit at Goldman, advising America's biggest companies on their multi-billion-dollar financings. Jonny Fine is back, Goldman Sachs Global Head of Investment Grade Debt. Welcome back, Jonny.
Thank you for having me.
What a good day to have you. I don't even know where to start. Let's start in Europe with these rising yields. What do you think the big concern is?
Well, obviously, it's the news coming out of France. There's a lot of uncertainty as to how this plays forward from here. We're not going to know more until really the week of July 4th. But ultimately, it's created a little bit of havoc in European rate markets, a little bit in European credit markets. I don't think there's really been a spillover much in towards the global stage. I'm not convinced that what we're seeing play out in terms of gyrations in US markets is particularly driven by what's happening in France. But it's one of the out of left field factors that's come in and started to derail sentiment a little bit, certainly on the other side of the Atlantic.
Is it just the political uncertainty here, or do you think there's fundamentally something being questioned about if Europe does shift to the right, what sort of economic policies does it get?
There's certainly part of that. So I think for sure the tails have gotten a little bit fatter over the course of the last few sessions. But I don't think this is doom and gloom. I think this is one factor. I think it bears watching very closely. As I said, we're not going to know more for several weeks from here, but people will start to prepare themselves for various different outcomes and therefore contingencies as a result.
I mean, the other thing it says to me is that this was the year of elections globally, and they're moving the markets. I mean, we saw it in India. We're seeing it with the Mexican peso, still trying to process that election. Of course, we look to the U.S. and wonder whether that's going to be a big market event, too.
Yeah, I mean, it almost certainly will. We'll tend to see a drop-off in liquidity in the run-up to the election. But insofar as rates are concerned, to me it's kind of interesting because I think there's 3 of 4 outcome scenarios that likely create upward pressure on yields in the US. And so when I kind of think about the 3 major policies that can do that, it's really fiscal policy. And fiscal policy, I think, will be expansionary in a unified government, no matter who wins. And I think both trade policy and immigration policy will be hawkish in a Trump administration, whether it's unified or divided. From a trade perspective, I think that means tariffs, which certainly in the short term are inflationary. And from an immigration perspective, its potential impacts on the labor market and whether or not we see more wage price inflation, labor market inflation, shortage of workers in the US economy. So 3 of those 4 scenarios, the other obviously being Biden in a divided Congress, I think are likely to be more inflationary and place upward pressure on yields. And we're seeing lots of people risk manage around that 3 out of 4 outcome as a result.
So a sweep by either side would be market negative, you think?
I think it will be for the Treasury market, because I think that means fiscal expansion and therefore kind of continued the same trend that we've seen, postponement of cuts, higher for longer, the environment that we've been in really for the last kind of couple of years now.
We've been, since we last had John, we've had a couple different chapters in the thinking about prices, right? We had some soft labor surveys, then we got the jobs number. We're going to see what retail sales and CPI bring. Is your mind changing week to week, or what is the smooth that out for us?
Well, I think the Fed's been remarkably consistent. They've said we'll be patient, and what we really need to see to begin our cutting cycle is real evidence that inflationary pressures have genuinely abated. And the picture's mixed. I think that's why we've probably had some of the equity market gyrations that we've had. But the picture's really mixed. Like, you're right, you pointed out some of the data that we'd refer to as a little softer. ISM, ADP coming in weaker. Some anecdotal evidence, listening to corporate CEOs, particularly in the consumer retail sector, might be indicating that, yeah, tighter monetary policy is now starting to bite. But then you get the payroll report from last week that turns everything on its head. So you have this mixed picture, and I think that will just allow the Fed to continue to follow this patient mantra.